of our inventory systems, LIFO, put it up here, oh, that L was big, has a few, I'll say maybe special circumstances to consider, or little nuances to it that we can discuss other than just the regular. So there are a few special items to consider with LIFO. The first one is that if you decide you want to use LIFO for, say tax purposes, but you want to use FIFO for your financial reporting purposes, then you're going to have to show the difference between those two. Same if you had a difference in any other tax effect and book effect. A lot of differences that we can find with those two. So you'll have to have an adjustment for that, or a difference. And for us, when we talk about that with LIFO, we call that a LIFO reserve. The difference between the valuation for LIFO and any other valuation, whether that be FIFO or specific identification or average, then we'll have that in a specific allowance account that relates into the LIFO value of the inventory. But again, it's commonly referred to as LIFO reserve. And when you have to change that allowance balance from one period to the next, then we call that the LIFO effect. So if that allowance was $10,000 last year, now it needs to be $15,000. That extra $5,000 that we had to change, we call that again a LIFO effect when we change those. Okay, so that's one issue, is the LIFO reserve and what that's actually talking about. Another issue deals with something called LIFO liquidation. Okay, LIFO liquidation, and this is referring to really what happens when you go through the layers of LIFO, and maybe you have to go through several layers in a year, and it's going to distort your net income just because you're not matching up the costs with the revenues in the correct period, which can happen with LIFO just because of the way LIFO works, last in, first out. So it's the oldest costs, not those that are the most recent or in the most recent period. But when we talk about LIFO liquidation, excuse me, was it LIFO liquidation? You've got, again, layers. So you've got current layers, and we'll talk more about layers in a minute. I'll give you some examples of these, but you've got layers from, say the current year, year before, several years, going back 10 years. But what if you had something where you had to liquidate these layers? So you went through all these layers and you went back, 8 years maybe through your inventory layers. Well, we call that a LIFO liquidation. And now, again, you're going to have a distortion in your net income, and that's going to mess with your taxable income as well when you have these types of LIFO liquidations. And this occurs a lot more frequently if you use the specific identification approach to LIFO. Again, where you have a lot of different inventory items, and you're using that specific goods approach to costing LIFO out. And that's your traditional LIFO. Sometimes you'll hear it called unit LIFO. Another way that you can do that, if you don't want to do specific goods, and it can help with liquidation a bit, to help with those problems, is to pool your inventory items into groups. And so that's called the specific goods pooled approach, or of LIFO, or LIFO approach. And that usually helps to decrease the amount of LIFO liquidations, because you've taken, instead of looking at one item, specific item at a time, you're pooling groups of items that are similar. Okay? Now, there's something that can be a little bit better, because when you pool those items, you have to replace it. If it gets replaced, it has to be replaced with something that is very similar to it. So if it's not similar enough, then it has to be treated as a new pool or a new group. So that doesn't really help us if we're having to replace things and they're not substantially the exact same thing. Then it's not really going to benefit us much. So we can go to something else called dollar value LIFO. And what this does is it determines these pools not in terms of their quantities or the types of items as much as it looks at the total dollar value. Okay, so it switches it from the physical quantity of goods and looks at it at total dollar value instead. Okay, so that's again going to help us with that LIFO liquidation issue that we had before. And you can interchange items in your pools a lot easier because they don't have to be exactly pretty much the same thing. Okay, again, and it helps prevent with that LIFO liquidation, or that erosion of your layers is another way to talk about it. So let's go through an example of dollar value LIFO, okay, and see how that works with some numbers. I'm just going to write up here, let's clear this out, maybe. Oh, there we go, okay. So we're looking at, let's do an example of dollar value LIFO. Okay, so let's put some data up here. Let's say that we've got, put some year-end dates. So we've got December the 31st, 2011, December the 31st, 2012, 2013, 2014, 2015, and 2016. So we got several years data. Oh Lord, I'm gonna have to keep these in order, right? You know how good that goes. Okay, so next column, let's look at ending inventory, and this is going to be at end of year prices or dollars. Okay, so it'll be that current year's pricing. So let's say for the first year we've got $80,000. We got 115,500. Then we've got 108. Then we've got 102. No, not 102. It's 122 too. Erase. Okay, try that again. 122,200. Then we've got 154. And we've got 176,900. Okay, so that's ending inventory at the end of year prices. All right, and then I want a price index. Okay, because again, when we talk about dollar value LIFO, we want to take the ending inventory at the end of the year and compare it back to the base year and recalculate it so it's all on the same dollar amount comparatively. So this is the base year, 2011. This is when we began this. So that's going to be 100. We got 100, 105. So our prices must have been going up. 120, 130, 140, and 145. Okay, so we've had increasing prices. So the first thing we want to do when we look at dollar value LIFO is I want to convert these numbers into base year pricing. So that's what we're going to use the price index for. So let's get ending inventory at the base year price. Okay, so this is the base year, so this one is going to be the same, but the way we find that out is we're going to take the $80,000 and we're going to divide it by 100%. But again, still going to be 80,000 because that is the base year. Okay, so if we take 115.5 and divide it by 105%, or 1.05, the price index, that's going to convert this back into base year dollars. Okay, because well, for this year it's 5% more. You can't always do that comparison, but so that means that when we do this, again, 115 dividing it by the price index, that's going to give me in base year prices $110,000. Okay. For 2013, we had 108,000 and that's 120 price index. So we're going to divide it by 120%, or 1.2, and that's going to give me $90,000. For 2014, again, same process, different numbers. You're going to find this to be $94,000. For 2015, you should be able to calculate 110,000. And for 2016, 122. Now, pause it right here. Make sure you can calculate these numbers. Do you know where they came from? Okay, make sure you can get these. So go back through, double check me. Make sure these are right. Hey, I could be wrong. It's happened plenty of times before. And make sure you can get these numbers too, okay? Pause it and then you can come back to us. Otherwise, I'm going to continue on, okay? So, the next thing I do, this just tells me how much our ending inventory at current prices for each of these years would be if we convert it to what it would have been in the base year, okay? That's what this number is giving me. That's going to allow me to get my LIFO layers for each year, okay? And so we'll make adjustments to those based on the price index and the change in these for each year as well, okay? So notice, and we'll kind of talk about this as we go through, but notice that from, 2011 to 2012, we went from 80 to 110, so we've got an increase of $30,000. From 2012 to 2013, we decreased by 20. From 13 to 14, we increased by 4. 14 to 15, we increased by 16. And from 15 to 16, we increased by 12. Okay, so this can go up and it can go down. And depending, we do things a little differently in the layers. So let's do our actual layers over here. Okay, in the first year, we'll do them each year. 2011. All right, well, that was the beginning year. So we, really only have one layer because that's, again, first year, so you can't have more than one layer. So we just have 80, but I'm going to set this up kind of like we would. You can do this, different ways. So we'll say 2011, and at the base year price, that is $80,000. And the price index, let's put a couple things. Our years over here, then let's put base year price. And let's put our index back again, our price index. And so my ending inventory, that should say inventory, not in. Not taking in lodgers today. Alright, ending inventory at LIFO cost. So this would be the actual amount of our LIFO cost for this. Well, again, it is the base year. So this is just going to be $80,000. Okay? So we got the $80,000, that's the base year price. Okay? $100 and $80,000. And we can do it for each year. I can just build upon. It really doesn't matter. I'll do it for each year so you can see the breakdown or the difference. All right, 2012. Well, we still have the 2011 layer. Possibly. Did we increase or decrease? Go back and look. We went from 80 to 110, so we did go up. So that means I've still got this $80,000 layer. I'm going to leave my headings without restating them. Okay? But we added, right? Did we add? Yeah. 2012, we said the change was 30,000 increase. So we've added a layer, $30,000. And that was at a price index of 105. Now, we've already used the 105 to get this 30,000 increase. But now what we have to do is actually take this and put it in the current year's dollars. That's why we're going to use it again. So now I'm taking the incremental and then now multiplying it back out by the price index to get the dollar amount it really was in that year. The reason you say, well, aren't you just reversing what you've already done? Not really, because I want to see the difference. Okay, we're taking any price inflation out to see the real difference in the change in inventory. That's what this is doing for me. Okay, so we can compare them all in the same pricing, and that tells me the change in units. Okay, this now, I can't, that's great. I need to know that because we have 30,000 more dollars in base year dollars in inventory, but I need to change the 105, the currency level, so that it can be put in that year's actual dollars, okay, so that we can have the value of it in that year. So we're going to take the 30,000 and multiply it by the 105, and that's going to give me our new number. Oh, sorry, pen wasn't working. And that should get 31.5. That's what I got. Okay, so 111,500 is the amount in 2012. We have 2 layers. Okay. Everybody good with that? Maybe. Maybe not. Hopefully. Okay. Okay, erase that. So if you go back and it'll be there, but erased it for the moment. So now let's continue on. That was 2012. So let's go to 2013. Again, if you'll remember those headings that we had. So we go from 110 to 90. So now we're decreasing. Okay, so when you decrease, what happens is it's called a peel back. You peel back a layer, or it may be more than one layer, but you start with the most recent layer and you go backwards and peel back. So remember before we had a layer of 80,000 and a layer of 30,000. So you start with the most current layer, which would be the 30. And we've got enough in that layer to peel it back, okay, because this was a decrease of 20. So now we've still got the 80. And that price index, I'm not putting my headings, but again, that price index is 100, so we've got 80,000 here. And then we had 30, but this decrease in 20 means that all that's left in that layer is 10. But you still value it at that year because we took it out of that year. So we've got the 105 here. So we've got $10,500. So now the total is going to be, is 90,500. Okay, 2013. So 2014. All right. So from 13 to 14, we increased 4,000. So we don't have to worry about any peel back. So we've got 80,000 at 100 still for 80,000. We've got the 10,000 at 105 for 10,500. And then now we have the extra 4,000. And that year was 130. So we've got that, which is 5,200. So if we add those together, we've got 95,700. 2014. See if I can squeeze 15 and 16 over here. Alright, 15. So from 14 to 15, we went from 94 to 110. So 16,000 increase. Okay, so still got the 80,000 at 100. We've still got the 10 at 105 for 10,500. We've still got the 4, 130 for 5,200, and now we have an extra 16, and the price index that year was 140. So now this is 22,400. So we add all that together, gives me 118,100. All right, 1 year, and I'm going to squeeze it in. All right, for 15 to 16, again, we increased $12,000. So that means we're going to have everything plus another layer. So we've got the 80,000. We've got the 10,000, we've got the, I don't know if I've got enough room, we've got the 4,000, we've got the 16,000, and now we have the 12,000. Alright, we had 100 here, 105, 130, 140, and now we've got 145. So we've got our 80,000, our 10,500, our 5,200, our 22,400, and now a 17,400. Alright, if you add all those together, I'm going to put it over the side because I'm running out of space. That should give you 135,500.